in September, we're going to see a change here at our own central bank with Raghuram Rajan heading back to the US. How is that being viewed, in your part of the world? I mean, are people talking about it? Has it dented the perception of India in any form or fashion?
Well, I mean, it has, but these things are very slow-moving things and very intangible. You don't end up getting sort of a riot in the financial markets because one person leaves. It never quite works that way, but it sort of rankles with many people that why was this done? And there's this quote in the book which a former central bank governor had given me during the East Asian financial crisis, that central bankers are like tea, like you only appreciate them when things are really hot. And I think that's the thing, that currently the Indian economy is looking a lot calmer than it was in 2013. So we see these personal changes and it doesn't seem to make such a big difference. But it's only when the going gets really tough do we appreciate as to who's in the chair out there. And that's something which I think is something for us to keep in mind.
But your thesis on the 10 parameters or indicators that you look at when you assess whether a nation is on the uptick or on the downward, where would India stack up on the good, bad and ugly today?
Well, if you sort of break the 10 rules down, I think that we get a score of basically 4-3-3, which is on 4 it stacks up relatively well. On 3, I'd say in the middle, and 3 clear negatives.
Okay.
So I'd say on a relative basis.
Elaborate that for us.
Yeah, on a relative basis, I'd say that India looks better because today there are 2 things to keep in mind. One, that no country looks good 10 on 10. In fact, that's rarely so, and especially in today's world where growth is low everywhere, it's very rare to see countries rank well. But if you look at the 10 parameters, where India ranks relatively well is that number one, that it feels cheap now, which is that the currency is much more competitive than it used to be, and you can see that foreign investment is coming in partly attracted by the fact that India looks relatively cheap compared to many other countries. Now, it's not doing as well as Vietnam or Bangladesh as far as exports are concerned, but FDI flows have picked up a lot and the currency feels cheap. So cheap is good. India ranks relatively well out there. India also ranks relatively good as far as the if you look at what's happening to the overall investment, that investments in the sweet spot in this country. Unfortunately, manufacturing and private investment aren't doing well, but at least India ranks relatively well as far as the overall sweet spot is concerned. Then the fact that India's debt levels haven't gone up much, because the big problem in the global economy today is that debt levels in the post crisis world have gone up very significantly, but in India's case debt levels haven't gone up that much, and I think that's a significant achievement as well. So I can keep stacking it up like that. On the negative side, as I said, hype really worries me about India. The other thing which worries me is the rule on geography, the fact that India doesn't trade enough with the rest of its neighbors, and very importantly the internal geography, that the population is very concentrated in the 5 metropolitan cities, and we just haven't seen the birth of enough new cities in India, unlike China, where we've seen the birth of new cities. The other big problem I have in India, as you know, is hype. That there's far too much hype as far as India is concerned compared to other countries. And one thing I've seen from all the work we have done is that when a country is very hyped up, then over the next 5 years, it typically disappoints because expectations are too high. And that's something, and also the policymakers get a bit complacent. You know, when they go about town telling how we're growing at 7 to 8%, there's a sense of complacency and arrogance which comes in.
Do you now believe the numbers or not?
No, I mean, of course not. I think that those numbers are, like I've always said, so are a complete joke. No one really believes those numbers. And I don't think that the numbers are being doctored. It's just incompetence. Like that old Indian saying that if it ain't broke, you fix it until it is broken. And I think that's what we have done with the GDP methodology, which is that it was, that those numbers were, at least if they were credible, even if they were not giving a good picture until the methodology was changed. Today they're making a basic mistake like GDP deflator being wrong, or something being wrong out there, that the overall real GDP number just seems completely ridiculous to most people who track these things. And we get all these exotic arguments in India about why that's going on. But again, in other countries, we don't hear these exotic arguments that commodity prices are falling very sharply. That's what's pulling the deflator down, and like all these explanations we get. But in other countries, I just don't hear these explanations, even though they are facing exactly the same global environment as India is facing with lower commodity prices. So I don't believe those numbers. But the more important part about India, which I think is a real problem for me, is the fact that this government hasn't done enough to withdraw from the public sector or from many spheres of economic activity, that India has the highest share of public sector banks in the world as a share of overall loans extended by the public sector. There's no other country like India where it's so dominated by the public sector, the overall lending.
So what do you make of the moves on that front? One, there is the consolidation, the PSB bank consolidation plan that the government is trying to move forward with. Two, this business of trying to address the stressed assets that public sector banks are laden with. What do you make of the efforts on that front?
I just don't think that's enough. I think that, that's all minor stuff. No one is really making the bold decision, and maybe it's too late for that. I mean, one other aspect I speak about in the book is that the sweet spot for carrying out economic reforms for any new leader
is in the first 2 years.
Is in the first 2 years, especially the first 6 to 12 months. That's really when sort of big reforms get carried out. I mean, today, for example, look at what's happening in a country like Argentina. It's coming back from the dead because the reforms that the leader there is taking out in the first 3 to 4 months, even at the cost of suffering big declines in his popularity, are huge, because he's looking at it from a 5-year perspective, that, where will I be 5 years from now? So that's what this government should have thought about in the first 6 to 12 months, that where I want to be 5 years from now. And so that's a huge missed opportunity with all the political capital to not have done something path-breaking, because everything is very incremental in nature. But we just have to accept incrementalism at a time when, like in the world today, there are so few places where even reforms are going on, where populism is on the rise. But there are places like Argentina or other places that are showing the way that when you have the back to the wall, you can carry out some very serious reforms as far as things are concerned. So I don't think that what's happening here with the restructuring of the public sector banks is really meaningful enough. The ownership is a real problem, and the one thing that the government just doesn't sort of realize, or at least doesn't sort of communicate well enough, is that if you do not privatize now, the value of these companies will just keep declining over time. I mean, just look at what's happened to MTNL, that in the last 15 years or so, the value of the telecom stocks in India is up 1,000% in the private sector, and the value of MTNL is down like 80-90% or so. Sector by sector, you can go ahead doing this. Look at what's happening on the private versus public sector banks, and this is the worst outcome, because the only people who are benefiting the most from this are the private sector companies, because they make supernormal profits when there's not enough competition out there and they're facing the public sector as competition. The consumer also doesn't benefit fully, because prices and services don't improve in their favor quite fast enough. So this is the worst case scenario, this privatization by malign neglect, where you basically have these companies which are still in play, the public sector companies, but the market shares are all being taken away by the private sector systematically.
That's an interesting way of putting it, privatization by malign neglect. But Ruchir, let me ask you about the 2 or 3 things that you're going to be watching out for in the short term as cues.
Well, I think that global cues still matter a lot, and I think that in that regard, it is a problem that asset prices across the world are very high in general, and India is no exception to that. So the fact that asset prices are very high puts some sort of a cap on equities across the world is what my feeling is. Having said that, I still feel that India and other emerging markets can do better over the next 3 to 5 years, because they've so dramatically underperformed over the last 5 years. I mean, in India's case, we have this tendency of looking at the Sensex and the Nifty in nominal terms, but not in dollar terms or even in inflation adjusted terms. Because if you look at it in those terms, like in dollar terms, the Sensex and the Nifty are still at well away from their multi-year highs, because the dollar has sort of appreciated so much against the rupee, and even in inflation adjusted terms. So we sort of tend to get lost in that a bit. So I think but to me the biggest fear still remains China, and I think that those worries come and go, but that really is my biggest fear, because the amount of debt that China has taken in the last 5 to 6 years to sustain their growth rates is something that no developing country in history has taken. I mean, just one statistic here to put that in perspective, that today in China, it takes $6 of debt to create $1 of GDP growth in China. At the peak of the US housing bubble in 2008, it was taking $3 of debt to create $1 of GDP growth in the United States. So that's really how severely indebted China has become today, and just seems to be continuing down that path. There's no relenting on that. As I say, that China's growth trajectory is like a ping pong ball bouncing down the stairs, which is the fact that the trend is clearly down, but every time the trend appears sharply down, they put some new stimulus, you get a lift, which lasts about 3 to 4 months, and then the downtrend resumes. And I think that trend in China to me hasn't changed.
Well, China is clearly ugly on the list of parameters that you put out, or your 10 rules to qualify nations on whether they're rising or falling. But Ruchir, it's always a pleasure speaking with you. Thanks very much for joining us on CNBC TV 18.